Most people skip this part of crypto, and that's why they fail. By the end of this video, you will learn from Reddit users something that 99% of traders and investors never know. Isn't crypto obviously a bubble? Approved answers. Can somebody explain to me how people don't think of crypto, a product with no final buyer that is literally, easily 99,999% of the time, only purchased by investors with the intent of selling it for a profit, inevitably to other investors doing the exact same thing, is not an extremely obvious bubble? It's like everybody realizes that all crypto is only worth whatever amount real money it can be exchanged for, but it still keeps growing in value. I also don't really understand why this completely arbitrarily limited thing is considered something that escapes inflation. It's tied to actual currencies, which don't. How is crypto anything except really good marketing, plus some smoke and mirrors?
It might be a bubble. Just because people buy it with the expectation to sell it at a higher price isn't what makes it a bubble, though. You could argue, naively, the same thing for stocks. The difference is that stocks are expected at some point, even if in the far future, to return cash to investors. Crypto is not. I think the zero or negative-sum game nature of crypto is really what makes it a bubble. The thing about bubbles is that you never really know it's one until it pops. Keynes said, "The market can stay irrational longer than you can stay solvent." I think that applies quite a lot to crypto.
I just read the bot, and I'm going to take the risk on not getting approved. I'm a computer scientist, not an economist. I can tell you from a technical standpoint that cryptocurrencies, without broader adoption, really are pure speculation. They are costly to produce, both in terms of money and the environment. The hashes that are brute forced are honestly just numbers. The values produced don't actually solve a problem or have a tangible value. It is honestly just a math problem with no efficient solution, so people have to throw ever-increasing amounts of hardware, power, and compute time at the problem. For the non-technical stuff, I will turn it over to actual economists.
The math problems are there to enable the mechanism that completes a transaction without the need of a traditional server.
Firstly, we have to remember that the price that a thing trades at depends on what people are willing to pay for it. That, in turn, depends on a great many things. I'm a mod, and I have read most of this long thread. There are dozens of comments that we mods have rejected. Let's start with a few positive cases for cryptocurrency. One argument is that the blockchain has useful technological applications. People say it can be used for data security, insurance, and supply chain. Perhaps this is true, though I have yet to be convinced. Even if this is true, there are some problems. The proposed applications could run on new blockchains that are tailored to the application. If they run on public blockchains, and there are reasons to do that, then really only one blockchain is needed, not the hundreds we have now. So, this isn't a very convincing positive case for most cryptocurrencies. It definitely isn't a good case for Bitcoin, since the auxiliary features of the Bitcoin blockchain are rarely used. Then there's anonymous transactions. Several blockchains support those. These are appealing for uses large and small. They can be used for illegal purposes, like drug dealing. Perhaps they can be used to hide assets in bankruptcy and divorce cases. They can be used to access gambling services that are illegal in some countries, such as the US. This bull thesis suffers from many of the problems of the above one. Only one blockchain, or at most, a few, are really be needed to support this activity. Many of the big-name cryptocurrencies like Bitcoin and Ethereum don't support anonymity features. It's also important to point out that the anonymity of these blockchains is constantly under attack by improvements in blockchain surveillance technology by law enforcement. Others argue that cryptocurrencies help people in the third world to escape using highly inflationary currencies. This is true, but there are many alternatives. Most importantly, people in those countries can use the dollar. The use of dollars is very common in Argentina, for example. In many cases, the transaction costs for using cryptocurrencies are high. But hand-to-hand transactions with paper money have fairly low transaction costs.
Another argument made is that cryptocurrencies will be useful in the future as currencies even in the developed world. These people will agree that only investors are buying cryptocurrencies now, but that this will change in the future. Some make the argument that governments will adopt them. This hasn't happened yet in a widespread way. El Salvador is famous for adopting Bitcoin. What has happened there is that it can be used alongside US dollars. There has not been particularly widespread adoption. Many people have Bitcoin Lightning wallets, but not many transactions are actually performed in Bitcoin. Cryptocurrencies are very volatile, which makes them a poor choice for a medium of exchange. Of course, they may become less volatile in the future, but at present we have no reason to think that they will. Also, most countries jealously protect the control they have over their currency. It seems that if a cryptocurrency were to threaten them, then it would be banned. Some countries have already banned all cryptocurrencies or some of them. So far, I have given 4 bull cases for cryptocurrency. Those are 1. Blockchain use in other applications. 2. Anonymous to illegal activity. 3. Developing world adoption due to inflation. 4. Later widespread usage. You may not believe any of these cases. I don't. But you have to remember that other people may believe one or more of them. With the above in mind, we should remember that cryptocurrencies provide no income. They are not like shares. A share represents a portion of shared ownership in a business, or something like that. Shares can pay dividends and stock buybacks from the profits. In this way, cryptocurrencies are like commodities which also are not tied to profits and can't pay dividends. Some people claim that existing money is just as ephemeral as cryptocurrencies. There are many problems with this view. The most important is that fiat currency is well established today. In my country, I can go to any shop and pay in euros. People are using them as a medium of exchange. This gives euros value. Notice that this makes sense from the point of view of each individual. We do not collectively agree in any sort of mystical sense that money has value. Rather, each of us value it according to what can be exchanged for it. With all that been said, is it easy to make money by betting against cryptocurrencies? No, because we can't predict the beliefs of others and when they will change. It may be that everyone who is buying a cryptocurrency believes in the greater fool theory. That is, that even though the asset is intrinsically worthless, they will be able to pass it on to a greater fool later. They may be right. We can't easily predict when they will become wrong. When a bubble bursts is surprisingly hard to predict before the event.
If you are not following this channel, you are already behind. The crypto moves fast, and staying updated here could be the difference between winning and watching others win. Follow for more hidden information about crypto